Hi, in this video, I will explain why I would only invest in two ETFs and hold them forever. If you are unsure of what ETFs to consider, as there are almost too many options out there, this video is for you. This is part of my new channel called Retire with Eric, the investing series to help you reach your financial freedom and retire young. The first ETF I would invest and hold forever is VOO, the Vanguard 500 Index Fund, which mimics the S&P 500 Index. So let's first understand a few basics of the S&P 500 Index. The index consists of the 500 largest companies listed in the US based on market cap. There are a number of other factors that allow a company to remain in the index, such as market liquidity, monthly trading volume, and profitability. The S&P 500 index is normally rebalanced quarterly. During this time, the weight of the individual stocks are updated due to market changes. And the company, also based on their qualifications, are either added or removed by the index committee. This is essentially a forced selection process to keep the best companies in the index to reflect the growth of the economy. A poorly performing company will eventually be eliminated and then replaced with a better one. As a result, the strongest and the best will survive. There are several exchange-traded funds that mirror the S&P 500 index, which an investor can purchase. They are passively managed, thus having a lower expense ratio than other types of ETFs. I prefer VOO over other similar ETFs, such as SPY, managed by BlackRock because of its lower expense ratio of 0.03%. and the flexibility of automatically reinvesting its dividends back to the fund. The 0.03% expense ratio means that the fund charges only $3 for every $10,000 invested versus SPY's $9 each year. On top of the annual appreciation, it's also paying 1.23% dividends back to you. Let's take a look at the top 10 companies in the index. You can see these are the mega cap technology companies and Berkshire Hathaway, chaired by Warren Buffett. It covers a wide range of sectors from technology to materials. VOO generated about 11% annual average return over the last 20 years. Since 2011, its value appreciated over 5-fold. Now, the second ETF I will invest and hold forever is QQQM, the Invesco Nasdaq 100 ETF. As the name suggests, mimics the Nasdaq 100 index. This index is represented by the largest 100 non-financial companies listed on the Nasdaq exchange. Like the S&P 500, it has its own qualification criteria and is rebalanced quarterly by Nasdaq and adjusted annually for inclusion or elimination of companies to or from the index. Nasdaq 100 index is more volatile than S&P 500 as it is heavily weighted toward growth stocks. This company offers no or little dividends. However, those are some of the most innovative and recognizable companies in the world, such as Apple, Microsoft, Amazon, Tesla, and Costco. The reason I choose QQQM instead of its older sibling QQQ is because of its reduced expense ratio of 0.15% versus 0.2% and higher dividend yield of 0.62% versus 0.57%. That's a combined $10 additional earning per $10,000 invested per year. For a 10-year period, this difference in earnings will be over $200 due to the compounding effect of all three factors: capital gains, dividends, and fees. Also, I'm not a trader. I buy and hold, where QQQ is more popular and liquid, which can be a good option for index traders. Now, let's take a closer look at its holdings. Again, they are the mega cap companies. The fund also includes a wide range of sectors, but it's dominated by technology companies, which make up close to 50%. QQQM's past 20-year annual average return is over 14%, beating VOO's 11%. Since QQQM was only incepted at end of 2020, I will use QQQ instead to show its performance as they perform the same. In comparison with VOO, the fund value increased almost 9-fold since 2011. This is the key reason I invest in QQQM. It's worth mentioning that there's an overlap between VOO and QQQM. I downloaded recent company data from both ETFs. You can see that 85 of the QQQM companies are also part of VOO. That's an 83% overlap for QQQM. Now you ask me, why buy both of this instead of just VOO? The reason lies with finding the right balance between concentration and diversification. Do you know that 80% of Warren Buffett's stock portfolio is concentrated only on just 9 stocks? Showing here in the second sheet, that's a total value of over $230 billion. Investing in over 500 largest companies offered by the 2 ETFs, I am well diversified. However, I wanted to introduce some concentration to my portfolio. The overlap between them provides me exactly that with limited risk added. If I had $10,000 to invest in both, I would put $8,000 on VOO and $2,000 on QQQM, considering my personal risk tolerance of being value versus growth-oriented investing style. And because of the 83% overlap, I am effectively allocating 30% of the money, or $3,000, on the overlapping companies. This is only a rough estimate since each company in each ETF is not equally weighted. For example, if you want to concentrate more on the overlapping companies, then you would just shift more towards QQQM. This act is asset allocation, which is critical for managing a successful, well-diversified portfolio. I will talk about this more in details in another video. So the strategy of passive investing is a form of leverage. Let the index committee members work for you by selecting the best qualified companies, and let the fund managers worry about updating weight adjustment each quarter during rebalancing. The cost of that to you is only $3 for VOO with $10,000 invested. While you're working hard for one of those companies in order to save more money for passive investing to continue to grow your net worth, or just fishing on the lake, you're getting rewarded with $150 annually via dividend payout, using VOO as an example, plus the long-term capital gain appreciation. I will dedicate one session to talk about the power of leverage in the future. Investing in VOO and QQQM is not only investing in the US economy and its future, but also the best companies that can continue to grow globally and outperform their competition. Why would you risk your hard-earned money elsewhere by not betting on the best of the best? This is a wealth sharing and generating vehicle where any ordinary individual can hop on and get a piece of the pie. If you believe in the US and its pro-business policies, which has been in place for decades, making companies the most innovative and world industry leaders, the S&P 500 and NASDAQ 100 index ETFs in this case, VOO and QQQM are the best choice to hold forever. Buffett once said, "Never bet against America," in his annual letter to shareholders. I wouldn't either. This is the viewpoint I would like you to see, the big picture, and this is common sense investing or big picture investing. As long as the US economy continues to grow with its population, I'm holding the 2 ETFs forever. Hope you enjoy watching the episode. Again, I'm Eric C. Please click on my headshot above to subscribe. Thank you and see you next time.